Okay, not gonna lie. Here's my pen. Not gonna lie, these journal entries are wonky, but in this lecture, I'm gonna go through preparing journal entries, at least as it relates to the work in process account. Okay, so we have three examples. The first example is going to deal with direct materials, right? And so if we just recall, we have material goes into work in process. Okay. So what's going to happen is everything is going to come out at actual and go in at standard. Okay. So what we're actually doing here is we're going to take $37,800 of actual material and put it into work in process. And we're going to put it into work in process at the standard cost. Okay. And so if we're thinking that we're going to make, I don't know, 1,000 units and each unit we think should cost us $35, that's how we come up with the 35,000. Okay. It is the standard cost. Now, the difference between the standard cost and the actual amounts, as we can see in this example, right, our actual cost exceeds our standard. And so we are automatically saying, listen, at the time of transfer, there is an unfavorable variance, okay? And if we were to go back up and look at the detail, we would see that there is a direct material price variance of $1,800. And what we're saying is that the the cost of our material per pound or per sheet was more than we anticipated. That was the price variance. And then in addition, we have a direct materials quantity variance, meaning we're using more material than we anticipated. Okay. And so since it's unfavorable, it means that we are adding to the cost. And so if I wanted to add to the cost and work in process, unfavorable adjustments would be debits to the work in process account. Okay. And they would also be direct material price variances. And that this way I have 37,800 in this account. Labor is going to work the same way. Okay. Labor, obviously, when I pay my employees, I'm paying them for the actual time, right? And so my labor is going to go into wages payable. It's a liability, so it's a credit. And that's going to be the actual hours times the actual rate. And then again, when it goes into work in process, it's going to go in at the standard cost. And so again, in this example, we're seeing an unfavorable difference of $100. But if you were to go look at the detail associated with labor, there are two variances when it comes to labor. There's the essentially the price or the rate variance, and then there's the efficiency variance, right? So the rate or price variance is what hourly rate did we pay, and the efficiency is how many hours did they actually use. And so in this example, we first see a favorable $1,600 labor efficiency. We must have used less quantity of labor. And then we see a 1,700 unfavorable rate or price, meaning we paid more and they worked fewer hours. All right. The net is that $100 unfavorable difference. And then last but not least, overhead, factory overhead. And again, this is all variable and all fixed. The two main variances are volume and controllable. Okay. And again, we're going into work in process at standard, and then we are coming out of factory overhead at actual. Okay. And we have a unfavorable variance of 1,500 and a favorable variance of 850. And this is all wrong.